So, good morning, good afternoon or good evening, depending on where you are located on the globe. It's my great pleasure to welcome you to the first of the three panels on central banks and inequality that the IMF, the Peterson Institute, and the Council on Economic Policies are organizing today, Friday, and next Monday. So, as you all know, the COVID crisis has severely hit all our economies around the world, and we'll all have to bear the consequences of it. But this crisis has not hit everybody with the same intensity. So vulnerable households have been particularly affected, and they must cope with a more severe impact on their income, while also having fewer financial resources to go through the crisis. So we don't have the figures yet, but it's very likely that the COVID crisis has increased inequality in our economies and will continue to impact inequality for a long time during and after the recovery. So against this background, we at the IMF, the Peterson Institute, and the Council on Economic Policies wanted to take a closer look at what would be the consequences of this shock on inequality for central banks, but also what role central banks can play to mitigate this shock and support vulnerable households going through these rough times. As you know, central banks play and have always played a crucial role in the economy, but most importantly, they've been at the forefront of the general policy reaction to the COVID crisis. So with this series of panels, we would like to focus on three policy fields, which are key for central banks: financial policy, basically micro and macro prudential policies that we will discuss today; financial market infrastructures, like with issues like financial inclusion, digital finance, and financial innovation that we will address in the panel on Friday; and last but not least, monetary policy, which is a topic of next Monday panel. So in all of this panel, we want to better understand what are the links between central bank policies in these fields and inequality, as well as explore how central banks can better take inequality into account in their policies and practices. So today, it's an honor for me to welcome Ratna, Sahay, Liviu, Voinea, Atif, Mian, and Joseph Gagnon to speak about our first topic, financial policies and inequality, COVID-19 and beyond. Ratna Sahay is a Deputy Director of the Monetary and Capital Market Department at the International Monetary Fund. She joined the IMF in 1989 and since then has worked in several departments, leading surveillance and program mission to several emerging market and low-income countries, as well as heading analytical project and policy paper and representing the fund in various forums. Liviu Voinea is a senior advisor to the executive director and member of the executive board at the IMF, representing Romania. He is a former deputy governor of the National Bank of Romania, responsible for financial stability. And prior to that, he was minister delegate for budget in the Romanian government and deputy minister of finance. Atif Mian is a John Laporte Professor of Economics, Public Policy and Finance at Princeton University and director of the Julius Rabinovich Center for Public Policy and Finance at the Princeton School of Public and International Affairs. And prior to joining Princeton, he taught at the University of California at Berkeley, at the University of Chicago Booth School of Business. And Professor Mian's study the connection between finance and the macroeconomy. He is also the author of the acclaimed book House of Debt with Amir Soufi. And finally, Joseph Gagnon is a senior fellow at the Peterson Institute. Before that, he was visiting associate director at the Division of Monetary Affairs at the US Federal Reserve Board, as well as associate director in the Division of International Finance of the US Federal Reserve Board. He has also served at the US Treasury Department and has taught at the Haas School of Business, University of California, Berkeley. I'm really thankful to Ratna, Liviu, Atif, and Joe to have accepted this invitation to participate to this panel. With financial policies and inequality, we are somewhat in uncharted territories. It's an issue that has not been explored in depth so far. And I'm sure that our panelists today will give us very valuable insights to better understand the nexus between central bank financial policies and inequality. Before giving the floor to Ratna, let me just tell you that we will have a first round of initial thoughts by our four panelists, and then I will open the floor to questions from the audience. If you have questions, please use the Q&A application that you can find at the bottom of your screen, and I will try to relay your question as best as possible to our panelists. So without further ado, let us start this panel, and Ratna, the floor is yours.
Thank you very much, Pierre. Good morning to most people. It's a real pleasure to present at this conference. So let me begin, but let me begin by first already violating one of the ideas that Pierre mentioned. My presentation is going to talk about inequality and finance, and inclusion becomes a very core part of it. So you'll see some of that, and of course I'll get to the regulatory side after that. So let me start sharing my screen. I have a few slides to share with you. Let me see. I just had it up here. Yeah. Okay. So, Pierre, can you see my screen? Yeah. Okay.
Yes, we can see.
Thank you. Thank you. Okay. So here's just starting really from the big picture. This chart simply tells you, when you look at it from a global perspective, wealth and income inequality have really risen since after the global financial crisis. And just to give you one shocking number, Oxfam estimates that in 2018, for example, 26 people's wealth was the same as 3.8 billion people. So that's quite shocking. So we have to think about inequality in any type of policy. Otherwise, it's simply unsustainable for many reasons, including political and social. Then when you look at the trends in inequality and the levels within countries, on the left-hand side, you see what are the trends, what proportion of countries in advanced economies versus emerging market and developing countries, income inequality as measured by the Gini coefficient is rising or decreasing. So what is clear on the left-hand side is that the trends are much worse in advanced economies. 53% of countries you see inequality rising. In emerging markets, it's much less. It's like 23%. And actually, impressively, to 52%, it's falling. But when you look at the levels, it's really interesting to see that advanced economies have lower inequality as compared to the emerging markets in developing countries. So in terms of trends, advanced economies are worse. In terms of level, the rest of the world is worse. So this chart looks at inequality and its relationship with the financial sector. It's based on a paper I wrote with my co-authors earlier this year. And this basically shows you that in the sample of countries that we looked at, which were about 120, 130 countries for which we have data since the early 90s. We group them in terms of where they have reached in financial inclusion. Here it's a very simple measure of ATMs per 100,000 adults. And then we explored whether countries which had higher financial inclusion, did they have lower inequality? And what we found on this panel cross-country study is that if you focus just on the low depth chart, which is the extreme left, that if you have greater financial inclusion as a country, you can actually reduce inequality by almost 10 percentage points in terms of the Gini coefficient. Whereas if you don't have much financial inclusion, then your returns are much lower. But we did this for countries where financial sector was developed or not developed. And we found that the same relationship held independent of the depth of the financial sector. At any level of financial development, this finding is very robust, that greater the financial inclusion, lower the inequality. We also looked at the relationship between financial inclusion of women and men. And in this chart, we looked at two aspects of inclusion, account holding and credit cards, which is a proxy for credit. And the bars basically show you the gender gaps. And in this chart, and the Gini coefficients also, as you can see, are the little triangles. So the key point here is that when gender gaps are higher, there is higher inequality as measured by the Gini. And this holds for both account holding as well as a measure of credit. Now, it is true that irrespective of whether it's men or women, as you know, if financial inclusion increases for both men and women, inequality falls. However, the returns are much higher when you close the gender gaps. And then when you look at financial inclusion itself, what you find is that traditionally measured simply as a share of account at a financial institution. So on the x-axis is the share of females, on the y-axis it's the share of males. And then there is the 45-degree line. So there are two key messages in this chart. First, that across the world, what you see is that the level of financial inclusion varies quite widely, because you see these dots, which represent countries. They are closer to the if you see on the left bottom side, they range from very low levels of financial inclusion to very high levels. And the second message is, of course, the gender gaps are quite high because you see most of the dots above the 45-degree line. But there are some green dots where financial inclusion is higher for women. And here's the most interesting chart. If you compare financial inclusion, not measured in a traditional sense, banking, etc., but if you include financial inclusion as measured by digital services, and by digital services we also include simply mobile phone where you do transactions. And when you do that, what you find is countries get cluttered at the top right, meaning more and more countries have increased financial inclusion through digital services. And the inequality between men and women, you definitely see. But still, there's a huge promise of fintech for financial inclusion. So if you look at traditional inclusion, on average, 60% of adult population have access to traditional financial inclusion. But if you look at digital services, almost 80% have access. So then when it comes to policies, there are many lessons here. So of course, there's a promise of fintech for increasing financial inclusion, because that helps reduce inequality, as I just showed you. But we want to be very careful that we don't leave the low-income households, the small firms, women behind. And we also promote digital services. And here are some policies that we have been recommending. We interviewed, this is in another paper, we over the course of 2 years, we did econometric studies, but also interviewed stakeholders. Fintech firms complain a lot about regulatory uncertainty. So that's something that the regulators and central bankers need to address. They really need to catch up with what's going on fintech. Another issue that has come up, both empirical and interviews, is it's surprising how little financial and digital literacy exists in all parts of the world, including very advanced economies like the US. Another aspect is that they complained about there's a global shortage of coders, the guys who actually help build great platforms. There's a need to also invest in these areas, both digital and physical infrastructure. There's a need to build trust. This is not just for inclusion, for other reasons as well. Consumer data protection, cybersecurity. A fifth one, which hasn't got a lot of attention, we really need to eliminate biases that were there in traditional services, which also then translate into when you have digital services, if one is not careful, because the first entry is by a human who entered the data. Then, of course, I talked about reducing gender gaps, because that helps reduce inequality. And then cross-border payments and credit is also important. So interoperability, open platforms are important. And finally, we also want to foster sufficient competition in digital services. And we can talk about that later, which is the big techs are a real threat to a lot of small companies. So then when it comes to financial sector policies, especially during COVID, what we are seeing is that, and recommending, is that the authorities support economy and the provision of credit, liquidity during this period. But of course, they also have to make sure that financial stability is ensured. Otherwise, it's really going to hurt these countries during the recovery phase. There are some international framework exists that have been guidelines that have been issued also by the FSB, and it's really the FSB has like 5 principles, and the international community has agreed to act consistently with these standards and not roll back reforms. And this is my second last chart. During this period, what we are recommending is that there is sufficient flexibility in the regulatory framework and the supervisory framework, and countries should use that. They should also help facilitate the support measures that are being provided by the government. Very important to maintain transparency, because credibility during this period is important. The supervisors, they have a lot on their plate, and they really need to become flexible and reprioritize their work during this period. And then, of course, with an eye to smoothing the functioning of the financial markets and services. So just focusing on the second one, the support measures, here, it is important to encourage and facilitate if a prudent attitude towards loans. If restructuring is needed, then the banks should be monitoring very closely, and it would be in their interest if loans need to be restructured. Of course, in general, even if there is a payment moratoria, borrowers who are non-performing before the pandemic should not benefit unduly from the government supported measures. And then the borrowers who've not been meaningfully affected, they should continue to pay their debt. And it's also important to not disincentivize the resumption of loan payments at the end of the moratorium. And if you're thinking of relaxing large exposures and concentration limits, you have to really watch for that. And finally, you have to have an exit strategy, as I mentioned, so that the borrowers will continue to pay. But of course, there are policy trade-offs, because you're facing the trade-off between supporting borrowers that are facing shocks and also weakening financial stability. And there are a lot of policies that are of consideration, and I can talk about that later. And finally, the key point I want to make, and this is from another paper, is this concern that came about, especially because of the global financial crisis, where a lot of loans, as you are well aware, subprime loans, were extended to small, low-income households. And because they were not well regulated, ultimately, the crisis in the US spread everywhere. What we found, based on financial sector assessment programs that we've done, is that you can have both financial inclusion and ensure financial stability. The two can go hand in hand. The major requirement is that regulation and supervision should be of high quality. So in this chart, when we look at bank stability measured by this Z-score, what we find is that you can extend to more and more customers loans, and financial stability can be maintained if you have high Basel core principles, the green dotted line, rather than if you have poor regulation and supervision, which is the red dotted line. So thank you very much, and I'll hand it back to Pierre.
Thank you very much, Ratna. Now we turn to Liviu, Voinea, and I hope that you can give us a bit of an insight from your own experience as Vice Governor of the National Bank of Romania, especially managing financial stability there.
Thank you, Pierre, and I'd like to thank Peterson Institute and Council of Economic Policies for inviting me. So, indeed, in my early years as deputy governor, I was struck by a brief encounter that I had with a young mother standing next to her baby stroller outside the local grocery store where I used to do my shopping. She didn't look particularly poor and she wasn't begging. Yet when I left the store, she gathered all her courage and asked me to spare a bottle of milk for her year and a half old baby, which I did. She immediately gave the bottle to her child, who suddenly stopped crying. Next day, in our monetary committee meeting, I raised the issue on how to make sure that our interest rate cuts trickle down all the way to the average people. How can we encourage sustainable access to credit for vulnerable households? Of course, I was perceived as a soft-hearted, progressive-minded central banker in an institution that was traditionally impersonal and conservative. Central banks do not deal with inequality, but should they? The following years prove that my genuine concern had actually greater financial stability implications. What was a heresy 10 or even 5 years ago is now acknowledged as an issue that deserves the attention of central bankers, and for good reasons too. I want to make today 3 points. First, that central banks should use more distributional household level data when deciding upon their monetary and financial policies. Second, the debt moratoria introduced during the COVID crisis were helpful to support financial stability and to prevent a further increase in inequality. But going forward, under budget constraints, the support measures should be better targeted towards the vulnerable households. And third, the increase in savings during the COVID crisis, like in other recessions, has not been driven by uncertainty, but rather by the need to compensate for the income losses that have already occurred. These compensatory savings will be even higher when the support measures will end. Therefore, we have a long road ahead of us until demand fully recovers and hence until inflation normalizes. The long-term difficulty to deflate debt will add additional strains to financial stability, especially to vulnerable households, despite lower interest rates and flexible macroprudential conditions. To stay within the scope of our panel, I will focus mostly on macroprudential policies. I think that access to distributional statistics is critically important for the design and success of central banks' policies. The National Bank of Romania took a series of financial stability decisions after calculating, transparently publishing, and carefully considering distributional statistics. The most important example that I could give refers to the decision to introduce a debt service to income limit effective as of January 1st, 2019. This measure, which was implementing following an IMF, FSAP recommendation, was based on an analysis of the loan level data from a comprehensive household credit register. We selected 200,000 mortgages and 500,000 consumer loans and cross-tabulated them with borrowers' information from tax returns. On the one hand, access to mortgage loans was very low for the first 3 quintiles of population. These households took instead much more expensive consumer loans and even resorted to predatory lending at very high rates on very short maturities. On the other hand, the debt service to income ratio for the first quintile of population was above 50% on mortgages and above 40% on consumer loans. This would gradually decrease to only 10% for the top quintile. Unemployed people had a 3 times higher probability of default than those employed. Among those employed, those earning between the minimum wage and the average wage had a debt service to income ratio in excess of 50%. Actually, below minimum wage was more than 100%. As compared to an overall DSTI, debt service to income, of 35%. We also found that an increase in the debt service to income from 40 to 60% would lead to an increase in the probability of default by 1/3. Based on all these distributional statistics, we decided to introduce a debt service to income limit of 40% for both mortgage and consumer loans altogether. And for consumer loans alone, the limit was subsequently set at 20%. At the first sight, this measure might seem as constraining low-income households, leading to adverse distributional effects because low-income households would then be less able to compensate income inequality through debt-financed consumption. However, in our public communication, we stress that this measure was designed to protect the vulnerable households from accumulating excessive debt, avoiding an even worse financial situation in the long term, which in turn would also affect banks. We also mentioned that the DSTI applied only to new loans, and we actually allowed for a 15% of all loans to be granted by banks as an exception from the rule based on their internal criteria, so that they could help households in a more difficult situation. After the first year of implementation, the average DSTI dropped by 8 percentage points, making vulnerable households better protected in the case of a crisis which actually came shortly afterwards. The COVID pandemic led to an overall drop in employment and wages, disproportionately affecting the low-income households, as you mentioned in the beginning. In the absence of temporary support schemes, the average income loss worldwide would have been 6.5%, whilst for the lowest paid 50% of workers, the average loss of income would have been 17%, according to the very recent global wage report published by the International Labour Organization. This drop in income for the lowest paid fueled the sharp increase in inequality everywhere in Europe, calculated as a ratio between top 10% and bottom 10%. In March, for example, 35% of the workers, and not only in Europe, in March, for example, 35% of workers in the US, 30% in the UK, and 20% in Germany had lower earnings than in February. This actually contradicts the theoretical existence of downward nominal wage rigidity. In fact, it proves the existence of downward nominal wage flexibility. This drop in income could have impacted financial stability in the absence of direct fiscal measures, mostly unemployment benefits, and debt moratoria. In Europe, according to EBA, the amount of loans subject to debt moratoria was close to 900 billion euro as of June 2020, representing actually 7.5% of total loans to the private sector. In Cyprus, this share was almost 50%. It was above 20% in Hungary and Portugal, and above 10% in Greece, Italy, Ireland, Iceland, but also in new member states like Poland, Romania, or Bulgaria. In nominal terms, the largest amount was in France, followed by Spain and Italy. These loans are not yet non-performing, but they are likely to become so. And 1 in 5 relief loans has already been provisioned for. Few days ago, EBA introduced new guidelines limiting the regulatory flexibility for this debt moratoria to a maximum period of 9 months, which in most cases expires in the first quarter next year. Counterfactual analysis, soon to be presented in the Financial Stability Report of the National Bank of Romania, shows for Romania that in the absence of such debt moratoria, the NPL ratio would have significantly increased for SMEs and marginally, but not insignificantly, for mortgages. Moreover, the distributional analysis shows that the probability of default rises proportionally with the debt service to income. In fact, 3 out of 4 over-indebted households, meaning still having over 40% debt service to income limit, 3 out of 4 over-indebted households applied for the debt moratorium. Adopting debt moratoria contributed to maintaining the asset quality indicators for banks and reduced liquidity pressures for households and SMEs. However, the number and distribution of those who took advantage of the debt moratoria are a good indication of future problems, and these moratoria will be phased out. The longer it takes for the economy to recover, the more difficult it would be for debt moratoria to be maintained in the current form. As Ratna said, we need an exit strategy. Going forward, distributional statistics would help central banks to better target these debt moratoria only to the vulnerable households, either by income group or by debt service to income limits, and would give banks time to focus on solutions for refinancing. In this context, central banks should systematically report on how inequality affects the efficiency of their policies and on how their policies affect inequality. Finally, what happens to the credit activity is related to the overall economic stance. The savings ratio has skyrocketed as the global economy plunged into crisis. In my personal view, that is detailed in my forthcoming book, Defensive Expectations, Reinventing the Phillips Curve as a Policy Mix, these savings are compensatory, being made to compensate for a loss of wealth that has already happened during the crisis. This is different from precautionary savings, which are driven by uncertainty. Why is this relevant? Because as people are loss averse, when their income falls, they will save more and spend less in order to compensate for that loss. In a recession, saving, that's my opinion, in a recession, saving is backward looking, not forward looking. This explains also why savings increase when we have very low interest rates. Households will not spend more until they fully recover what they lost as a measure of stock. And until this gap is closed, households will not spend as expected and credit activity will not recover. Then it means that demand will not recover. Therefore, an optimum policy mix between the monetary and the fiscal policies should target the vulnerable households which lost the most during the crisis and which are key for restoring demand. Thank you.
Thank you very much, Liviu. Very interesting insights from Romania and from your data. Atif, I guess you're gonna speak more about that after these two presentations.
Thanks, Pierre, for for having me. I will talk about finance or financial policy and inequality. You know, we have all, I believe, heard this story of a frog who's sitting on a pot of water which is slowly boiling, slowly heating up, and the frog never realizes that the water is actually getting warmer and warmer until it's too late, and you know, the frog cannot jump out of the water. What this story tells us is that sometimes it's these slow-moving forces, the gradual but persistent forces that we may not perceive on a day-to-day basis. It is actually those forces that are the most important. And so I would like us to keep this analogy of the frog in mind when we talk about finance and inequality or financial policy and inequality. And what I'm going to talk about is, I'll try to emphasize that actually inequality, and when I say inequality, I don't mean inequality in a general sense of the word. I mean inequality very specifically in the sense of extreme inequality, which is the share of income or wealth, as Ratna was emphasizing, going to the top 1%. It's really the top 1% that matters, by the way, in terms of what the stuff that I'm going to talk about. But again, coming back to the frog analogy, what the core point I'm going to say here is that inequality actually is of first order importance and is one of the most important factors right now, if not the factor right now, that is relevant for understanding financial markets, financial policy, as well as economic growth. This is a bit of a strong claim, if you will, because that's not how we traditionally think about either finance or macro. And so that's why I'm going to spend a bit of time explaining why that is the case. It's sort of a bold statement, but I've increasingly come to believe in this strong statement given the work that I've done recently. And just for those who are interested in digging deeper into this question, I will refer them to the recent work that I've done with Amir Sufi and Ludwig Straub at Chicago and Harvard, respectively, a couple of papers, Intended Demand and Savings Glut of the Rich. Those have the main points that I'm going to touch upon. So what's the connection between inequality and finance? What is this rising temperature that we have not been fully internalizing that we should have for a while now? Well, the first point, I'm going to make two sort of conceptual points here. And the first one really is that finance is not what we think it is at some level. What do I mean by that? Well, if you went back to your standard textbook model of finance, what are we taught about what finance does? What we are taught about what finance does is that there are savers who try to save, and then there are entrepreneurs who get that saving through the financial sector, and then they invest, and everyone lives happily ever after, right? That's sort of the typical finance story. There's nothing wrong with it. It's not that I'm saying the story is wrong. It's exactly right. This happens. But this story is incomplete in a very important way, and this is where I'm going to connect finance with inequality. The reason this particular story is wrong is that while the financial sector does what this story tells us it does, at the margin, the big growth in finance since the 1980s, by and large, has nothing to do with the story. So if we want to understand the change in finance, if we want to understand the change in financial sector, by and large, this particular story is not really an accurate description of finance. And one very simple way of understanding it is, if you go from 1980 to today, we know investment to GDP has not gone up at all. In fact, if anything, it has slightly trended downwards. And yet, all of us know financial sector as a share of GDP has more than doubled, and even more in some countries. So what is going on? What is this huge expansion in finance doing since the 1980s? That's where the traditional story is no longer valid. So what is actually going on? So this is where we investigated a bit more carefully. And the bottom line is that by and large, this expansion in finance is explained by rising inequality on one side, which is sort of the supply of credit, if you will. And then it's actually very straightforward to explain why. We know that the very rich, the top 1%, have very high propensity to save out of permanent or lifetime income. And so as the share of income going to them rises higher and higher, naturally what happens is the supply of savings, which is the same thing as the supply of credit to the economy, is going to rise higher and higher as a share of the pie, the GDP. Now, if this rise in saving were to be absorbed as higher investment, just like our traditional textbook story tells us, everything would be hunky-dory and we would live happily ever after. The problem is, as I've already said, investment has not risen. So where is all this money going? And when you look at it, this money is primarily going in what is you can classify as financialization of the economy, which is levering up of existing assets. Another way to say the same thing, because the economy is an ecosystem and things have to balance, supply has to equal demand, both on the good side as well as on the credit side. It's the bottom 90% that has been borrowing more and more or dissaving more and more. Both processes have been going on. It's the bottom 90% that has been borrowing or dissaving more and more to absorb the savings, the increased savings of the top 1%. This is what we refer to as the saving glut of the rich. That's in fact the title of one of the papers that I was referencing earlier. And this process of rising inequality in the presence of stagnant investment and hence increasing financialization of the economy is the core problem we are facing right now. And let me just quickly come to COVID. What COVID has done, and both the speakers before me exactly have emphasized this as well. The one unique factor about COVID is that it is the most unequal recession we have seen in modern era. Not just the depth of the recession, but it's the most unequal. You know, by and large, people, including people like everyone on this panel, we are the Zoom economy, right? We have not been affected as much. All the pain is really at the bottom. So COVID is hitting exactly at the fracture which has been deepening over time, and that's why it's so serious. And this process is unsustainable. That's the core thing, and I'll come to macroprudential and so on. But this is really the core. Again, that's why I said it's the frog analogy. This is, we're all going to boil here if you don't pay attention to it. Let me say a few things on the macroprudential side. And again, I'm going to say something which perhaps may sound a bit extreme, but I think that's right. Macroprudential is obviously important. All the usual that, you know, one should not overextend, leverage ratios and so on, they're all important. But while they are important in the usual sense of the word, they are not relevant anymore. That's an important distinction. Why do I say they are not relevant anymore? Let me make an analogy to kind of explain that point a little bit more. The reason they are not relevant anymore is in the same sense that monetary policy is not relevant anymore. That's not to say monetary policy is not important. You can do silly stuff with monetary policy. So you want to avoid mistakes. In the same way, you want to avoid mistakes on the macroprudential side. But monetary policy is irrelevant, as all of us know. That's not a controversial point because it's not effective anymore. It's not relevant anymore. It's not the force that you really that really can change things on the margin. So exactly in that sense of monetary policy not being relevant anymore, macroprudential policy is also not relevant anymore, precisely because of the important role of inequality in finance. So let me explain that a bit more. Keep in the background the context of water getting hotter, which is this rising inequality and saving glut of the rich. In that macro framework, if you try to lean against rising credit, what's going to happen? If you don't change the structural force and you have this saving glut of the rich, if you lean against that through macro-proof, monetary policy, whatever tool you may end up using, no matter which tool you use, you're going to force the economy into a recession. That's what I mean by monetary and macroprudential is no longer relevant, because the structural force is too strong. And if you try to lean against that, you will get embedded into a liquidity trap, because there'll be too much savings at the very top, and you're preventing those savings from going anywhere in the real economy through consumption, through borrowed capital and consumption. And so it's in that sense that macroprudential policy has become irrelevant. So let me now just close by again going back to, we need to understand that we are boiling in this water, which is the heat is inequality. It's become unsustainable. Let me just give one telltale sign of unsustainability, which is the long run interest rate, sometimes R star as it is called in technical lingo. It is precisely because of this heat that I emphasized in the beginning that R star or long run interest rate has been trending down from 1980 and has gone all the way down in negative territory in real terms. That's the sufficient statistic that tells us everything we need to know in a way. And one way to think of are we doing the right thing is to talk about policies that will get R star to move in a positive direction. And the problem with the status quo is that if you binge on more credit, that pushes R star further down. This is the point we make in this paper we call indebted demand. So the technical aspects, I'll refer the audience to that paper. But the intuition is actually extremely straightforward. If the solution to problem is more debt, one consequence of that is that the interest rate cannot move higher anymore, because now you have even more debt. And if interest rate were to rise, the debt service burden of existing debt will be so large that everyone will kind of go underwater. So this is sort of the mega or the meta macroprudential point. It's not the usual macroprudential point, it's the general equilibrium macroprudential point. And we need to internalize all of these forces. This is the water that is going to boil all of us. We need to internalize all of these forces. So I'm going to just end on this important point, and COVID has just brought this point home for the reasons I already mentioned. We cannot ignore the consequences of this extreme global inequality that we have. It has to be addressed. The core thing is 2 points on the policy side. The first one is public investment in areas where the returns to those investment disproportionately go to the bottom 90%. We can talk about what that means, but that's key. Public investment has to rise. And I mean investment, I don't mean transfers. Public investment has to rise. Number 2, we need redistributive policies. And that means both things, by the way. It means lowering of tax burden on the bottom 90%, direct and indirect, like payroll would be one example in the US. And then raising taxes, which includes inheritance taxes, estate taxes. So not just talking about income taxes. And we need to think very seriously about wealth taxes and think of practical ways of implementing that at the very top end. Again, it's a very serious problem, and I think we need sort of a realization of the extent of the problem and deal with it head on. Thank you very much.
Thanks a lot, Atif. A very broad view of the problem, and appreciate that. Joe, the final round of remarks for you, and then we will come to Q&A. Just I remind you, if you have a question, then use the Q&A box at the bottom of your screen. Thank you.
Okay, thank you, Pierre. So I'm at a bit of a disadvantage here because the other speakers have all done a lot of research in this area, and I have not, but I've been a long-standing researcher and practitioner of monetary policy. I'm going to start talking about COVID a little bit, just because I think that was an emphasis that you brought, Pierre. And as both you and Liviu noted, the COVID pandemic has profoundly increased inequality. And to say that in the context of income inequality is almost embarrassing, because COVID is increasing inequality in ways that we aren't measuring at all in economics. Most notably that mortality from COVID is much worse at the lower end of the income distribution. This is a huge, huge problem, which we have to say is number one, but also in education, whereby it's really hurt the education of low-income families, and that won't show up for a long time in any income inequality data. So it is a huge crisis that has profound inequality effects. I think in terms of response, policy response, and I'm going to limit myself to the economic policy response. Obviously, health policy is critical, but we're not here to talk about that today. The key point, in my view, is that this isn't the topic today, but it just needs to be said that the key policy obviously needs to be fiscal policy. Only fiscal policy can really transfer the money targeted to where it's needed. People who are hurt, especially at the bottom end of the income distribution, they need transfers. Loans is a distant second best and limited in capacity. Low interest rates that central banks can give is just distant third best. So central banks, yes, they need to set interest rates, policy rates where they need to achieve their mandates, which almost certainly means very low interest rates and lots of purchases of government debt to make it possible for governments to finance these transfers. A brief side note, if central banks can do fiscal policy in a few countries, apparently it is legally possible, including the ECB, then they should by all means do fiscal transfers, helicopter money, call it what you will. And in the United States, I know this is actually legally forbidden for the Federal Reserve to make transfers. So this is unfortunate. But the Federal Reserve can help in many ways, but it cannot do fiscal policy in this country. So both Ratna and Liviu talked a little bit about the regulatory relaxation. So getting more to the topic of today's session, that some relaxation of lending standards in the crisis is certainly appropriate. And I would say, given the uncertainty with which so much uncertainty about who's going to be affected and who can they repay, and it would be crazy to clamp down and use normal standards on foreclosing on loans in the midst of a crisis when we really don't know what the world's going to look like coming out, and we have some hope that fiscal policy could help. So absolutely, regulatory forbearance, relaxation, call it what you will, is absolutely critical. But it isn't the first order policy that we need. As I say, I think fiscal is going to be key, and that includes guaranteeing some of these loans, subsidizing some of these loans, making them forgivable, government forgiveness under certain conditions, but that's really fiscal policy. But regulatory policy needs to work hand in hand with that. Just a little brief note on my personal topic, which is quantitative easing. I know it's not today's topic, but just to note that it is true that quantitative easing, which central banks are doing in this context, contributes to wealth inequality. And we've seen the stock market in the US break records, which clearly increases wealth inequality in America. And it's partly due to the quantitative easing, but it's also partly due to the nature of the fiscal response, which wasn't as targeted narrowly as it could have been. And therefore, a lot of high income households who got transfers are saving that money and buying stocks. I think it would be nice to see income inequality studied more in splitting into between labor income and capital income, because I think what you'd find is that QE has very different effects on labor income inequality versus capital income inequality. It does raise wealth inequality, but QE helps labor income at the bottom much more than at the top, overwhelmingly so. And so for low income households, this effect is just hugely important, as Ben Bernanke has said repeatedly. And as Ratna said in the paper, the background paper, which I read, what we really would like to have is more granular data to understand these links between financial regulation and inclusion and inequality. And one granularity thing I think I would propose to people is really seeing the difference between labor income inequality, and capital income inequality would be useful. In particular, the literature finds really large, impressive correlations in some dimensions between elements of financial regulation, financial stability, financial inclusion, and inequality, really large, which is eye-opening and reflects something really going on. But we have to be careful that we need to understand the transmission mechanism underneath that, because we do risk that there could be third omitted factors there going on that affect both inequality and the financial sector in ways that raise this correlation. And if you don't take awareness of that, your actions on one side of that equation might not have the effect you expect on the other side if you don't know the transmission mechanism. I think that's a key point to keep in mind. So I think a big point that I didn't see in this literature or in the discussion today was just a general talk about how financial boom and bust, which is what financial regulation fundamentally is usually aimed at controlling, how financial boom and bust affect inequality. Ratna has some information in her paper that shows that financial booms tend to raise inequality and they actually lower it in the bust, which would seem to be a good effect. But I think there, the distinction between labor income and capital income would be especially important because I expect in terms of labor income, it's just the opposite. And that may be what matters more for the low income households. So I think more work there, I think would be very helpful. You know, I think we know that historically, financial liberalizations have led to this boom bust cycle in many countries around the world. It's a very common pattern. And so understanding the inequality implications of that really need to be, I think, studied more and more granularly, as Ratna indicated. So let me just finally conclude with two specific points, just motivated by today's discussion so far. One is, I think, certainly Atif is absolutely right on the saving glut of the rich and how inequality has really driven finance, especially in the US, but I think in other countries too, in the past couple of decades. And I think this is a key point that people need to recognize more. What's less clear to me from this literature, and I didn't hear it today from Atif, is, you know, this seems to me this mainly that inequality is driving the change in finance, not vice versa, but is there some senses in which that's not true? I'd like to hear if Atif thought so. Atif says that macroprudential policy is contractionary, and yes, that's true if you mean that preventing some of these loans from the richest to the less well-off sometimes are excessive, and we saw that in the housing bubble, and if we had clamped down on those no-doc loans and whatever, it would have been contractionary macroeconomically. That's certainly true. It would have lowered our star. But it seems to me that something he didn't stress enough is fiscal redistribution policy ought to then raise our star. It ought to be expansionary because you're taking income and wealth away from the high savers and giving it to the low savers. And I think that seems to me a very important thing. So if fiscal expansion and more public debt is the answer, as I think it is, and investment programs that help the low income are wonderful, I totally agree, but even just pure redistribution ought to be helpful in this regard, to be expansionary, to raise our star, to make monetary policy more effective. And I'm curious, I think something that Atif had written said that he thought both private and public debts were harmful for lowering our star, but I don't understand why public debts would be. There's a long literature that I've worked on that shows that public debt actually raises our star. And I don't know if that, I don't believe that's changed. And then final point, just briefly on to Liviu, made a brief comment that is off topic here, but I couldn't help but catch on to it. He mentioned that maybe in the COVID crisis, there's less evidence of downward nominal wage rigidity, but I'm surprised. I don't know what's going on in Romania, but in the United States, I would have said exactly the opposite. This COVID crisis has really shown the importance of downward nominal wage rigidity. There's been a collapse of labor, and yet measured wages went up. And of course, that's because the people at the bottom were more likely to lose their jobs. But the key point is that people are not taking pay cuts to save their jobs by any means. In fact, it was quite the opposite. There was a bit of a movement afoot, although it didn't get very far, to actually raise wages in the crisis because of the extra costs it was imposing on people. That didn't get very far, but there certainly was no evidence in the US of anyone taking a lower wage to get more work. I'll stop there. Thank you.
Thank you very much. So there's 15 minutes remaining for questions, and I would like to summarize a bit a few comments that have been written in the Q&A section with a concrete question, maybe to Ratna and Liviu. As you both, I mean, let me illustrate that, but what is happening here in Switzerland. So the reaction here was really to make loans very cheap and available for everyone who needed some cash, right? And as you mentioned, Liviu, this is a ticking bomb, in a sense. Like at one point, these loans have to be repaid, and Ratna, you emphasize that these loans must be repaid. So how do we deal with, you know, the sequence or the timing of that? So there are some moratoriums in place that will progressively be lifted. You know, the first payment or repayment will come in the next few months. So how do we deal with this situation concretely? What would be your recommendation? And then another question after also that I think is more global for Atif. You know, a question: can we really achieve financial stability without mitigating extreme inequality? So is it, and actually, can the central bank kind of justify the action on inequality by saying that it's detrimental to financial stability, that too much inequality is detrimental to financial stability? I don't know if any of you want to respond on this question and take the floor now.
Here, I can start with this tough question, which relates to the severe trade-offs we see because of the COVID crisis, and everybody agrees that support measures are needed. But then the question arises, really, the question actually arises only because we don't know when this crisis will end. Because if they were short-lived, well-targeted, transparent, you know, you can deal with that. So let me begin by saying that we supported at the IMF, you know, large-scale moratoria and government guarantees because the shock was so huge. But at the same time, we are concerned quite a bit about the moral hazard problem that can arise if they direct very scarce resources to firms that may not be viable. And then, of course, this additional problem, you know, the advanced economies have already high debt. The others, not as much, but they are also fiscally constrained. So there's quite, with government guarantees, you can have pretty large contingent liabilities and high fiscal risks. So we have to worry about that also. So I'm just going to make one key point here. And the key point I want to make is that actually what is really important is that the banks can play a huge big role. How can the banks play a big role? The support, the banks and the authorities. So let me say both. And as we go along, these widespread measures should become much more targeted, as you know more about, you know, where the needs are the highest. Now, turning to banks, you know, the banks, they can play an important role by restructuring loans. They have the maximum information, you know, which companies, firms are viable, were viable before, or not viable, and which ones have run into a problem only because of this crisis. So they should be adjusting the terms of the contract. They can help borrowers manage the temporary impact, and they can also minimize their own losses. So it should be in their own interest to change the terms of the loans for borrowers that are viable in the medium term in their assessment. Government can't do that. They don't have all the information on this. And because loan restructuring, they're really commercial decisions, they will themselves tend to be more targeted and therefore less negative implications than a blanket moratoria. So bottom line is, as the crisis evolves, broad moratoria should be phased out, while they should be moved more, or loan restructurings by banks should play a much larger role. We do want the banks, on moral hazard, to maintain some skin in the game. So let me stop.
Pierre, to answer your question on basically the exit strategy, and I'm coming from a country that cannot afford limitless fiscal deficits, and I think most countries actually cannot afford unless they issue reserve currency, and that's at least in the medium and long term. So I think for any measure, there are three very important dimensions: timing, dosage, and distribution. So I think, okay, it was a good timing now to take these measures, but gradually we need to restrict them, so to limit the dosage and to be more careful about the distribution of these measures. I don't have like a silver bullet or something, but it's I mean, I tend to disagree respectfully with macroprudential policies being the culprit and bringing the recession when you are in good times, because I think actually unsustainable credit is the one that brings recession. So macroprudential policies actually help, yes, limit the credit, but limit the credit to sustainable ones. So therefore, the potential recession which comes at some point will be less intense. And now it's a reverse. I mean, the flexibility cannot be again limitless. You need to have some flexibility, and of course, but you can target this flexibility towards those really in need. There are various support measures that can have or would be introduced by various central banks, and here the combination, they must work together with government, because many of them can be based on fiscal incentives or some kind of guarantees or something which are not in the parohy of central bank. It is important for central bank to continue supervising banks closely, so that they would not, have a very loose standards. On the other hand, as I said, but you need to know who is really in need. We need distributional statistics. Once we have it, we can apply it. So it's not necessarily one policy for all. It can be more targeted. Could, for example, provide income, some kind of income support, or postpone credit repayment, or reduce debt payments for a while and extend the maturity of the loan, and without banks considering as non-performing loans and having to provision for it. So there are ways to do it, but you cannot do it all the time for all the loans. You can do it from now on for a limited period, for a limited number of loans.
Thank you very much. Atif, you want to go back on the question whether decreasing inequality could be a solution for more financial stability or something, as it was suggested?
Well, I mean, absolutely. I mean, I think, as I said from the beginning, that is the core structural or the primitive problem that we are facing. That's why I started with the frog analogy, that, it is, look, sometimes pruning is the right approach. You just need to prune your garden, and the next time it will be fine. But sometimes the problem is much deeper, right? You really need to dig out the weeds and plant new plants and things of that sort. So I think what we are desperately, I would say, in need of structural changes, because the current financial system is, or the economic system rather, is not sustainable. I mean, that's the basic picture that comes out of analyzing the consequences of rising extreme inequality and savings glut of the rich that I emphasized. And it's in that sense that I say, look, the standard policies which are designed to tackle business cycle fluctuations, all of that intuition is exactly right, but it's not relevant. We are not facing a business cycle problem. We are facing a structural problem. There's a key distinction between the two. And that's all I'm emphasizing here, that more and more the business cycle variation is also being generated in a sense by that fundamental structural issue. Precisely, for example, that you need credit creation to keep the economy afloat, but that obviously has some side effects as well, that every once in a while you'll go overboard and things of that sort. But now at this point, you can't avoid not focusing on the structural problem, because even credit extension is no longer possible in the private sector, essentially, because everybody is levered to the hilt, and now the only place that can expand on the credit side is the public sector. And while I fully support deficit financing, because that's the only game in town, don't get me wrong, what I'm saying is that that's not going to solve the structural problem, and you're going to remain stuck at R star very low. Just on the side, I know we are running out of time, but Joseph asked some excellent questions on public versus private debt. And you're absolutely right. The two are not symmetric, Joseph. There is a difference, but it's a longer conversation. We're actually working on a new paper on precisely on that question. It really matters whether R that the governments can borrow at is less than G or not, and things of that nature. So it's a little bit more nuanced question, but I know we are short of time, and I want to give Joseph some time to respond as well.
Do you want to respond to the question or add comments?
No, I would only make one comment, which responds to all three of the people, and I think Atif basically alluded to right now. But there's a new paper by Jason Furman at PIIE and Larry Summers, which looks at how you measure government debt burdens and correct measurement of government debt burdens. And they find that despite very high debt to GDP ratios in some countries, the true measure of debt burden is exceptionally low right now. And depending on the assumptions, it could actually be infinitely low. So that's the R minus G thing. But the government interest expense ability to carry this debt has never been stronger. But of course, as Liviu mentioned, you do need to issue this debt in your own currency, that you have your own central bank. If you're Greece and your central bank is in Frankfurt, you're in trouble. But for the rest of us, I don't know about Romania, you don't have to have reserve currency. You just need to have a central bank that has a mandate for price stability and issues its own currency. I'll stop there.
Thank you very much. So we're arriving to the end of this panel. A huge thank you to all of you. It was very inspiring, and it shows how the depth of the issue that debt, financial stability, and inequality raises. For the audience, I just want to remind you that this is a series of 3 panels on central banking and on central banks and inequality. The next 2 will address the issue of financial market infrastructure and inequality, and that's on Friday. You can register on the PIIE website or on the CEP website. And the last panel will be next Monday on monetary policy and inequality. That being said, thank you very much for participating, and I hope you will have a good end of the day for all of you. Thank you very much.
Thank you. It was a pleasure.
Thank you.